In question 16, we are asked about the capital asset pricing model, or CAPM. In the context of corporate finance, is CAPM used to determine A, the cost of equity for a company, B, the market value of a company's capital assets, or C, the beta of a company? Now, we know from the reading that there are a number of methods for calculating the cost of equity for a company, and in this course, it just happens to be the case that the very important CAPM method is the one that is discussed in a fair amount of detail. So we are fairly sure that A is the correct answer. The CAPM is used in corporate finance to determine the cost of equity for a company. Let's look very quickly at B and C and what is wrong with those two. B is a nonsensical mix of terms from the reading thrown together by the examiner to create a hopefully plausible distractor for the underprepared student. C, the beta of a company, is rather more interesting because beta is one of the inputs to the CAPM equation. It is not, however, in the context of corporate finance, and especially not for this introductory course, the main purpose of the financial manager applying the CAPM equation. So beta is an input. It is not the output for our purposes of the CAPM equation. In question 17, we are given some information and we are asked to calculate the weight of equity in the WACC equation. We know that the WACC weights should be calculated using the target capital structure of the company. In this situation, we have not been given that target capital structure. If we do not have the target capital structure, but we have the market values of the equity and the debt in the company, then we can use those market values to determine the weights of equity and debt in the WACC equation, as long as those market values are representative of the target capital structure of the company. Now, none of those conditions apply in this situation. We are only given the book value of assets and the book value of debt, and therefore the answer to question 17 is based on the supplied information we simply do not know, and that is choice C. In question 18, we are asked again about the capital asset pricing model. This time we are asked what the specification of the CAPM equation is, in the sense that the equation tells us that the cost of equity is directly related to, and we're given three options there. Now, we know from the reading that there are three variables that are input into the CAPM equation in order to calculate the cost of equity, and they are the risk-free rate, the market risk premium, also sometimes known as the equity risk premium, and the beta of the company's shares. Now, at first sight, as we scan through A, B, and C, we see none of those options there, but there is one additional level of detail related to that market risk premium or equity risk premium, and that is that it is defined as the overall stock market return minus the risk-free rate. So we confirm that A, the cost of debt, is definitely not one of the three variables going into the CAPM equation, nor is the inflation rate, but C is in fact the market risk premium by another name. So the answer to 18 is C. For question 19, we are asked here about cost of capital calculations in corporate finance. In that context, what is the risk-free rate? What is it most accurately described as being? Is it A, defensive because it has no risk? Now, that is wrong. That is absolute nonsense. It is yet again an example of a distractor put there by the examiner, which takes random terms from the reading and throws them together. That is absolute nonsense. A is of no interest to us, it is wrong. B, based on the government's cost of borrowing. Now, the risk-free rate is the yield on government bonds, but given in the reading is an additional detail about another interpretation of that yield, the yield on government bonds, and that is exactly the same thing as the government's cost of borrowing. So B is in fact the right answer, but let us quickly scan choice C to ensure that that is definitely incorrect, because we are happy with B. C tells us that the risk-free rate is derived from the overall stock market return, and that once again is completely wrong. So for 19, the correct answer is B. In question 20, we are asked here about the yield to maturity approach, and specifically we are looking at the cost of debt for a company. The yield to maturity approach is used by a company that has bonds in its capital structure. It has issued bonds, and those bonds are actively traded. Under such conditions, you have all the inputs required to calculate this so-called yield to maturity, which for our purposes equates to the cost of debt for the company. So A looks correct to us, but as a check, we will go through B and C and see what, if anything, is wrong with those. For B, we are offered the yield to maturity on actively traded comparable bonds issued by other companies. And I emphasized there the word comparable because that should hopefully remind you that when we are looking at comparable bonds, we are in fact looking at something called matrix pricing. And that applies when the company has bonds in issue, but they are not actively traded. Therefore, it does not know the price of those particular bonds, and therefore it looks to a peer group of companies and their bonds in issue in order to determine a cost of debt as an approximation approach. So B is matrix pricing. It is not the yield to maturity approach. And C is wrong because the prime or other rate charged by a company's bank is not relevant for a company that uses the yield to maturity approach, because we use the prime or other borrowing rate charged by the company's bank in situations where the company has no bonds in issue, and we don't call that the yield to maturity approach, which obviously applies when the company has issued bonds. So C is for a company that borrows directly from banks without issuing bonds. B is for a company that can't use the yield to maturity approach because its bonds are not actively traded, and we confirm that A is the correct answer. And that concludes part 4 of this review of the Introductory Corporate Finance mock exam. And thank you very much for making it this far, and I will see you in the next and final one of this particular series.